Hey everyone, welcome. So, have you ever heard those terms flying around? Index fund, mutual fund, ETF, and felt like you were supposed to know what they are, but didn't? Well, you're in the right place. Because today, we're going to break down exactly what these things are, nice and simple, so you can finally get what all the fuss is about.
Okay, so before we get into the different types of funds, what even is a fund? Let's stick with that party analogy. It's actually perfect. You and your friends all want to throw an amazing party. Instead of one person trying to buy everything, you all chip in, right? You pool your money. And with that bigger budget, you can suddenly afford way more stuff. And that, right there, is basically how a fund works. Lots of people pool their money together to buy a whole bunch of different investments. It's teamwork for your money.
All right, first up, let's talk about the one you've probably seen all over social media, the index fund. People love to call it the ultimate set-it-and-forget-it investment. But what does that really mean? What are you actually buying? But here's the thing. To really get what an index fund is, you first have to know what an index is. And it's simpler than it sounds. Think of it like a scoreboard for one part of the stock market. You've probably heard of the S&P 500, right? That's an index. It's just a list that tracks the performance of 500 of the biggest companies in the US.
And this is the big idea. An index fund doesn't have some genius manager trying to find the next hot stock. Nope. They call it passively managed, which is just a fancy way of saying its only job is to buy all the stocks on that index, like the S&P 500, and just copy it. That's it. It's a follower, not a hero trying to save the day.
So why is this passive thing such a big deal? Well, it all comes down to one word: cost. Because there's no expensive team of Wall Street analysts trying to pick winners, the fees are incredibly, ridiculously low. This number here is the expense ratio, basically the annual fee. An index fund might charge as little as 0.02%. I mean, think about that. If you invest $1,000, you're paying just 20 cents for the whole year. That's it.
Okay, here's another little detail you should know. Unlike a regular stock, which you can buy and sell any second of the day, an index fund only gets priced once per day, right after the market closes. All the buy and sell orders get processed at that one price. Now, for most people who are in it for the long haul, this isn't a huge deal. But hey, it's good to know, right?
So you see, index funds are all about this idea of passive investing. The goal isn't to be a hero, it's just to copy the market and get the same returns. And that leads us right into the complete opposite strategy: active investing, which has a much, much bigger ambition.
All right, let's switch gears and talk about mutual funds. If an index fund is the quiet follower, a mutual fund is the superstar quarterback. You've got a professional manager and their whole team doing tons of research, trying to handpick the investments they think are going to be the next big winners and beat the market.
I mean, having a pro pick stocks for you sounds pretty awesome, right? But that expertise isn't free, not even close. You're paying for that manager's salary, their team, their research, and it all adds up. As you can see, the fees for mutual funds are way, way higher, often 1% or even more.
And this, folks, is the million-dollar question in the world of investing. Even with those high-paid experts, study after study shows that most of them actually fail to beat the simple, boring old market average over the long run. You're paying extra for that star picker, but those higher fees act like a ball and chain, making it super tough to actually come out ahead.
Now, if mutual funds are about trying to beat the market, hedge funds take that same idea and crank it up to 11. Yeah, we're talking about a whole different league now. Hedge funds are all about using complex, aggressive, and sometimes super risky strategies to try and hit absolute home runs.
So, can you just go out and buy into a hedge fund like you can with the others? What do you think? The answer is a big, fat no. This is a very exclusive club.
Yeah, these are not for your average Joe. Hedge funds are usually restricted to what they call accredited investors, which is basically a legal term for people who are already very wealthy. And there's a good reason for that. The strategies can be so risky that regulators want to make sure anyone who gets in can actually afford to lose all their money.
And their fees? Oh boy, their fees tell the whole story. They're famous for the 2 and 20 model. That means they charge a 2% fee every single year, no matter what, and they take a 20% cut of any profits they make for you. It's the definition of high risk, high reward.
Okay, last but definitely not least, let's talk about ETFs, or exchange-traded funds. The best way to think about an ETF is like a modern hybrid. It cleverly takes some of the best features of everything we've talked about and rolls them into one.
So what's the big deal with ETFs? Why does everyone talk about them? It's because they give you the best of both worlds. On one hand, you get the diversification of a fund. One share can own hundreds of different stocks. But on the other hand, it trades on the stock market all day long, just like a single stock. You can buy or sell it anytime the market is open.
And get this, here's the other huge plus. Just like our friend, the index fund, the vast majority of ETFs are also passively managed. They just track an index. And what does that mean? You guessed it, very, very low fees. So you get that trading flexibility and the low cost.
Phew. Okay, we've covered the follower, the star picker, the high-stakes game, and the flexible hybrid. So let's line them all up, side by side, on a final scoreboard to make it super clear.
Okay, take a look at this. This chart really puts everything into perspective. You can see right away what's passive, what's active, how they trade, and most importantly, what they cost. It really cuts through the noise and shows you who each of these is really built for. So after all that, what's the big takeaway here? Look, for most of us who are just trying to invest for our long-term goals, like retirement, it really boils down to two main choices: index funds and ETFs. Why? Because that combination of super low costs, dead simple strategy, and instant diversification is just an incredibly powerful formula for building wealth over time.
All right, so there you have it. You now know the tools of the trade. And this isn't just about memorizing some definitions. It's about understanding the different game plans you can use to build your own financial future. So the question really isn't, what are these things anymore? It's, now that I know the tools, how am I going to build my future?